Good evening, class. Good evening, class.
Good evening.
Asante. We stopped at methods of calculating depreciations. Methods of calculating depreciation. I want us to start with the first method. That is what we call the straight line method. We start this with topic 4, straight line method. So what is straight line method? What is a straight line method as a method of calculating depreciation? What do you know about the straight line method? So we said that under straight line method, depreciation is basically spread evenly over an entire useful life of an asset. That depreciation is basically spread evenly over an entire life of an asset altogether. So to mean that when you hit the straight line method, then we expect that depreciations of an asset should be equal on each year. So we can notice say that under this method, depreciation is spread evenly over the useful life of an asset. That the depreciation is spread evenly over the useful life of an asset. Is spread evenly over the useful life of an asset. We say depreciation is determined as follows. So under the following method, depreciation is basically determined as follows. We say that using the straight line method, depreciation per annum should be equal to the cost minus scrap value, so what you call the residual value over expected useful life of an asset. Together, team, up to that very point. So we say that under the straight line method, depreciation is basically spread evenly over an entire life of an asset. That's why we say that depreciation per annum is basically cost minus the scrap value or the zero value over the expected useful life of an asset. Together, team. Are we together before we pick an illustration? So we can define a number of things, What is what you call the scrap value? We can ask ourselves, what is scrap value? And then what is the scrap value? What is the scrap value of an asset? Mercy, what is the scrap value? So when you talk about the scrap value, is the expected value of an asset at the end of useful life of an asset. Let's say, for example, an asset, is supposed to be there for 5 years altogether. We're saying that the useful life of an asset is 10 years. For some assets, you find them after 10 years, then they totally do not have any value. But for some assets, you say that after 5 years, they will still have some value, and that is what you call the useful life of an asset. And that is what you call the useful life of an asset. Together, team. That is what you call the useful life of an asset. At the end of the useful life, if that asset can still fetch some value, then that is what you call the scrap value. Together, team.
Yes.
So we call it the expected value. The expected value of an asset of an asset at the end of the useful life of an asset. At the end of the useful life of an asset, the expected value together. The expected value of an asset at the end of the useful life of an asset together. At the end of the useful life of an asset. So we cannot say it's the amount or just call it amount. Let's call it amount. Or you can say or say amount expected, amount the business entity, amount the business entity, expect to sell the asset, after the period of use. The amount that the business expects to sell the asset. So we can have the first illustration. How we can get that illustration. Illustration 1. We have that illustration 1. So illustration 1. So I'm saying, just to repeat, when you talk about the straight line method, that is the expected value of an asset. At the end, we say that straight line method is we spread depreciation evenly over the entire useful life of an asset. For example, an asset is 1,000 altogether, and every year it's losing 20%. We know that automatically it's losing 25%. That is, it will take about five years. 20% of 1,000, that is 200. So on a yearly basis, we have depreciation to be 200. So we can have what now? I can note it down. ABC Limited, as an ABC Limited bought an asset at a cost, we say at a cost of 1 million, and the estimated value estimated useful life and the estimated useful life of 10 years, and the estimated useful life of 10 years, and the estimated useful life of 10 years, and post op, we just have post op and say the asset is expected to be shillings 100,000 at the end of the useful life. To be shillings 100,000 at the end of the useful life. It's expected to be shillings 100,000 at the end of useful life. So we can go through that. Do you have the question? Tuko sawa, tumeona swali. We respond. Asante. So if you're using this altogether, what is the depreciation? Say that the depreciation is basically cost minus scrap from residual. So you give scrap from residual value over what you call the useful life. useful life. So what is the cost? The cost of the asset is how much? Cost of the
1 million.
asset is how much?
1 million.
1 million. Do you have a scrap value in this question? Do you have a scrap value in this question? Do you have a scrap value?
Yeah.
What is the scrap value? We've said that at the end of the useful life is expected to be shillings 100,000. So the scrap value is
100,000.
100,000. So 100,000 over the useful life. What is the useful life? The period that I
10
expect, how many?
10 years.
10 years. So what is the depreciation per annum? What is the depreciation per annum?
90,000.
How much?
1,000.
I cannot hear you. What is the depreciation?
90,000.
90,000. So for 10 years, every year, we expect that the depreciation should be 90,000 until 10 years. So if we start year 1, depreciation is 90,000, sorry. Year 2, 90,000 up to the year 10. Year 10, we also have a depreciation of 90,000 altogether. So for 10 years, we'll have a depreciation for how much in total? That's 900,000 together.
Yeah.
Then in summary, we just have summary. At times, most of the time, we're not given residual value. Are we together? We are not given residual value or any other thing altogether. So in this case altogether, when you're given rate and cost, depreciation using the straight line will simply be, D will simply be cost times rate. And rate in this case is percentage altogether. So if you're not given the useful life and etc., using the straight line method, we'll say that depreciation is equal to cost times rate altogether. Rate of depreciation, cost and the rate of depreciation. If you look at the papers, most of the papers would apply this formula. Took us out.
Yeah.
Yes, most of the questions would. I want to give you an illustration that you'll do when you're seated down. You'll just copy this so that I give it out. So I can give this illustration as something that you can do wherever you're seated alone somewhere. So you can note it down that this illustration is now yours. Are we together? This illustration is now so note it somewhere. Just say an equipment was acquired in 2020 as assignment, just illustration as you do it. Equipment was acquired in 2020. The equipment was acquired in 2020 at a cost of shillings 5 million. The equipment was acquired in the year 2020 at a cost of 20 million. First off, I say depreciation is on a straight line. Depreciation is on a straight line at the rate of 20%. Depreciation is on a straight line at the rate of 20%. At the rate of 20%. Calculate depreciation for the year ended. Calculate depreciation for the year ended. We say DEC 2020, DEC 2021, DEC 2022, DEC 2022, DEC 2023, and finally, DEC that first, we know that all of them are the first DEC 2024. So this can be done by you as an assignment. So that is okay. So now we're going to apply this. Two copper module.
Mm.
Yes, I can maybe illustrate the first year. That is deck, the first deck 2020. So just say the position is cost times the rate of depreciation, rate of deep. So 2020 should be cost of 5 million times 20%. What is 20% of 5 million? That should be 1 million. To copper module. Are we together?
Yes.
To copper module. Ellen?
Yes, we are together.
So this what you can do for 2021, 2022, and that together. So we go to the next method, which is called reducing balance method. What's called reducing balance method. What is a reducing balance method? When you say reducing balance method, when you say reducing balance method, what do you think we mean by reducing balance method? Reducing balance method. What is the reducing balance method? So under reducing balance method, you must remember that we calculate depreciation based on net book value together. We calculate depreciation based on net book value. So we basically calculate depreciation based on what we call the net book value. The question is, what is the net book value? Net book value should be equivalent to cost minus accumulated depreciation minus accumulated depreciation. So when you talk about reducing balance, we calculate depreciation based on net value, and you're saying that net value should be cost minus accumulated depreciation, minus the accumulated depreciation. Together, team.
Yeah.
Go pamoja. So I think we can just pick and we write something just a minute as I get what we need to write. So managers. So we can put it down and say the position, say this. Under this method, depreciation is calculated on net book value. Is calculated on net book value of the asset, or net book value of the asset. So under that method, depreciation is calculated based on net book value. What is net book value? Net book value. What is the net book value? We say that net book value is equal to cost minus accumulated minus accumulated depreciation. Minus accumulated depreciation. So that is what we call the net book value. That is what we call the net book value. That is what we call cost minus accumulated depreciation. We can grab the board and have our second illustration. So many. Now our illustration, I dictate it. Say this. A acquired an equipment. Illustration. We say A acquired an equipment. A acquired an equipment. A acquired an equipment in 2020. In 2020 at the cost of shillings 5 million. Shillings 5 million. You say the asset is depreciated at on depreciated on a reducing balance, is depreciated on a reducing balance at the rate of 20% per annum. At the rate of 20% per annum. We say calculate depreciation for the year ended 2020, 2021, 2022, 2023, 2024, and 2025, and 2025. So calculate the position for the year ended 2020, we have 2021, 2022, 2023, 2024, and 2025. Together, team. So using reducing balance. Reducing balance is the same as diminishing method altogether. It's also called diminishing method altogether. And you know at the back of our mind, the keyword is to not understand, we calculate to net book value. So net book value should be cost minus accumulated depreciation. So we can start with the first year together, and that is 2020. So now, are we seeing that? Are we there?
Yes, we are fine.
So that is on this is cost of net value. So if you look at 2021, the asset was 5 million. So there's not any loss of value. Is that okay? There's not any loss of value. So there's, unless we were told there's accumulated depreciation that was carried. So 2021, there's no loss of value. So we have a rate of depreciation So depreciation, we call it depreciation, and that is rate. So then we have the rate of depreciation, rate of dep. Then you have the depreciation. Then we have the net book value. That is at the end. What's now the net book value? So what is the cost? The cost is 5 million per year. Then the rate is 20%. What is the depreciation if it's 20%? What is the value? What is the value? 20% and 5 million. What do you have?
1 million.
5 million times 20%. 5 million times 20%.
$1 million.
1 million. So at the end of the year, if you're looking at the value of the asset, what will be the net book value? Cost minus accumulated depreciation. So at the end of 2020, we have the net book value be 4 million. So for next year, this is the value that we're using together. Tuko pamoja. Tumeelewana?
Yeah.
So I proceed to 2021. What is the net book value? We don't use 5 million, but the net book value is now 4 million. Tuko pamoja times 20%. The rate of depreciation is 20%. So what is 20% of 4 million? What is 20% of 4 million?
800,000.
What is
800,000.
20% of 4 million?
800,000.
20% of 4 million? Ninyi ndio wangoja. Or I get my calc too. If you're still delaying, I can get my calc. So what is 20% of 4 million? 20% of 4 million? %of 4 million, that should be 800,000. So tuko pamoja? Are we together? Tuko pamoja. Everybody, are we together?
Yeah, we're together.
Asante. So what is the net value? 4 million minus that. What is the net value? 4 million minus that?
3.2 million.
3.2 million. So 3.2 million. So when I get to the year 2020, please attention, don't make noise. We have 3.2 million. The rate is 20%. So what is 20% of that in the year 2022? So what do you have the position for the year 2022? Ningapi? I should not be the one doing it. You should be also having your cards. So what is 20% of 3.2? What is the value? The value should be 640. Are we in agreement that is 640? Are we in agreement? Are we in agreement that is 640? So what is 3.2 minus 640? So that should be 25, 60, 2,500,000 the net value. So when we have 2023, the net value should be 25, 60, 2,560. Then you multiply by 20%. So what is 20% of that? That is in the year 2023. So we have that is 512. So what is the net value? Then 560 minus 512. What is the net book value? Kindly give me this so that I don't move alone. What is the net book value at the end of 2023? So that should be 2,048,000. 2,048,000. That should be 2,048,000. That should be 2,048,000. Then you proceed to 2024. 2024, the net value is now 2,048,000 times 20%. So 20%. So what is 20% of that? So that should be 49,600, 49,600, 49,600, 49,600. So we have 1,638,400. 638,400. Then the last year, which is 2025, the last year, which is 2025, the net value is 1,638,400 times 20%. What is 20% of that? What is 20% of that? Munipati year for the last year. Triple tower. The last year, Elizabeth, it's good to see you back. What is 20% of this? 1,638,400. And we need to have calc. Tafadhali, we need to have calc. In our class, lazima tukuwe na calc. What is that? So that I don't move alone. I can be actually alone. So what is that? We don't need to waste time.
3.
What is that?
That 3.
3?
That 3 is 70.
3?
That's that 376,000.
3 what? You simply just take a calc, 1,638,400 times 20%.
See, that's
We have
70.
327,
600.
680. Are we having that? So what is the net value as at the last year, which is 2025? So we minus from that 1,638,400. So that is 1 million. What is the figure?
1 million.
1 million. Say 310, 720. Lazima to participate. This is a calculation. If you don't participate, then we make it difficult for us altogether. So are we sorted on this? Do we understand how we've gotten these figures? Nani elewi? Yeah, great, Elizabeth. So we understand this is the reducing balance method, also called the diminishing balance method altogether, also called the diminishing balance method. You have to have a calc. For this, you can't survive without a calc, so make sure that you have calc. I know. So at the end of 5 years, we know that the asset will still have a value of 1 million. After the end of 1, 2, 3, 4, 5, 6. At the end of the 6 years, we know this. Then we know that these are accumulated depreciation for those 6 years. Okay, to get accumulated depreciation. Sawa. So that is done for that. I want us to proceed. Most of the questions are together, especially when you tackle financial statements are together. Most of the questions will always love using what we call, what you call straight line method and reducing balance method. However, you can have some of the methods that you use revaluation. I can talk about briefly two methods. One, we call it revaluation methods. Very fast. Revaluation method. Very fast. So on revaluation method, basically we look at the value of the asset at the beginning of the year, and we also value the asset at the end of the year. So the difference between the value at the beginning of the year and at the end of the year, that's what we call revaluation method altogether. So we call it this method. This method is often used to estimate depreciation of lost tools. So then you say it involves valuation of assets at the beginning
Do you mind dictating?
Do I mind?
Dictating again. The line that you've written, kuna mahali hapo chini sioni mimi.
Sawa. I'm dictating again. I've said that this involves.
Thank you.
Valuation of the asset. Valuation of the asset. At the start of the the start. This involves valuation of this asset at the start and at the end of the year.
Okay.
At the start and at the end of the year.
Thank you.
Then first of all, say the difference represents depreciation. The difference basically represents depreciation. The difference represents depreciation. The difference Elizabeth, I've not ignored you. I've been whatever computer that you're using, the computer that you're using, are we together? I'll check. Maybe there's a lock in it altogether. I may not use those. I'll check. I'll just ask the person concerned here, and that's so that we'll be using those slides. But at the moment, bear with me altogether. Maybe there's a lot. The capacity is a lot. There's a lot of things in it. So then I want us to have the last thing very fast. Then we pick on something. So I want us to talk about not very common, we call it sum of digit method. Have you ever heard of this method? Sum of digit method. Have you heard of it? Sum of digit method. Who has ever heard of this? Betty, have you heard of the sum of digit method? Have you ever heard of this method of depreciation?
Just in a mention, but I don't know how it works.
How it works. We can discuss it. Very fast.
Yes, in a mention, but I don't know how it works.
Yes, we call it under this method, under this method, under this method, under this method. Depreciation is computed under this method. Depreciation is computed based on the sum of year digits. based on sum of year digits. Sum of the year digits. So sum of the year digits, formula will basically say the formula is Sn is equals to n into n plus 1 over 2 over n plus 2. I want to give what I mean by Sn. So Sn simply stands for Sn is equals to sum of year digits, sum of year digits, sum of year digits, n is what you call expected useful life. Expected useful life. Expected useful life. Expected useful life. To copy more, then we have our illustration. Before we do an illustration, I just wanted to bring ourselves attention to majority of the students. Sometimes students are not very keen on deposition. You're given the value of the asset at the beginning, and at the same time, we will the value of the asset at the end. So at the beginning, you'll find the value of the asset is very high, and at the end, the value of the asset is very low. So we always say that at the end of the day, what basically causes that will be the deposition. So simple sense, you just notice that why is that happening? At the beginning, I had a value of 5 million. At the end, now I have a value of 4 million. Such differences, we will automatically know that as a result of what? Either deposition or disposal altogether. When you look at that, you'll always see that either deposition or disposal, or two things have happened. Asset has lost value, and at the same time, we've disposed an asset altogether. So illustration. So we say ABC Limited. We can say ABC Limited acquired a machine. Acquired a machine at a cost. We say at a cost of 600,000. At a cost of 600,000, and estimated useful life is 5 years. Estimated useful life is 5 years. And estimated useful life is 5 years. Estimated useful life is 5 years. Then I want us required compute annual deposition, compute the annual deposition of the machine over the entire useful life, using the sum of year digit method. 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 To Kokomoto. Are we together? To Kokomoto. I want us to respond to yes. To Kokomoto. Are we together?
Yes.
So
yes,
we'll get the sum of year digits, which is Sn is equals to n into bracket n plus 1 over 2. So useful life, n is the useful life. So we have 5 into bracket 5 plus 1 over 2. So this is to say 5 times 6 over 2. This is 3. So sum of year digits name 15. 15. Are we getting the same value? Are we having the same value? Using the formula, do we have 15?
Yes.
Great. So we said that year 1, using the sum of year digits, year 1 for 5 years, year 1, we say we use 5, we start with 5, over the sum of year digits, times what? The cost of an asset. So what do we have for year one? What is the depreciation for year one? 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 Year one.
$200,000.
So 5/15 times 600,000. That is the cost. Year two,
200,000, 200,000.
saying 200,000. So year two, that should be 4/15 times 600,000. Then you have year three, 3/15 times 600,000. Then you have year four, that should be 2/15 times 600,000. Then you have, that cannot be seen. Let me wrap this other end. So that year three, we have that. So year three. So I can cross this distance you're not able to see, and we do it on this other edge. For year three, that should be 3/15 times 600,000. Year four,
Year three.
that should be 2/15. You say? Hello. Then finally year five.
Year four is 160.
Year four, this the last year is over 15 times 600,000. So year two is on. Year two is one. You're saying 160. Is it 160?
160.
Then
Yes. Yes.
year three is
120.
120. Year four, year four is
Then year four is 80.
year four is 80. And lastly,
That is 40,000.
40,000. So that is how we use the sum of sum of the digits methods going together. Sum of the year digits methods. Together. So then I proceed to accounting treatment. Understood? Elizabeth, you've been out a lot. What is happening to your internet? Accounting for depreciation. Accounting for depreciation. How do you account for depreciation? Accounting for depreciation. How do we account for depreciation? Accounting treatment for depreciation. How do we account for depreciation? How do we account for depreciation? How do we account for depreciation? Number one, we must understand that depreciation is basically an expense in the P&L altogether. Depreciation is basically an expense in the P&L. And when you take it to the statement of financial position, we need to less the depreciation on the value of the fixed asset altogether. We need to less the depreciation on the value of the fixed asset. So we say the annual depreciation, the annual depreciation is a revenue expenditure. The annual is a revenue. So you say it is deducted from the total value, from the total value of income, in computation of profit and loss. In computation of profit and loss. So we basically say that that is a revenue expenditure. We normally deduct it from the total income in computation of profit and loss. 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 Then we say accounting entries. Entries of annual depreciation are as follows. We did double entries. What are the double entries? What do we debit and what do we credit? What do you debit? What is accounting entry for depreciation? What is accounting entries for depreciation? What is accounting entry for depreciation? Ellen. What do you debit?
Depreciation expense.
So that is we debit income statement. If it's depreciation, we debit income statement because that's an expense. Then we credit provision for depreciation. Then you credit provision for depreciation. Are we together? We debit income statement because that's an expense, and we credit provision for depreciation. Sawa. Together. Are we together?
Yes.
Asante. I want us to talk about depreciation briefly. I want us to take on disposal. What is disposal? We take on disposal and we talk about those entries. What is disposal as a practice? And what are the accounting entries for disposal? What is disposal when you talk about disposal? I was explaining something that sometimes you're given assets altogether. You're given assets. Sometimes you're given asset. You're told at the beginning of the year the asset was 5 million. At the end, asset is maybe 2 million altogether. You're not told anything. But upon looking at that, some of the things that are likely to happen when you have value of asset reducing is that either asset has depreciated, which is obvious, and at the same time, asset is disposed. Maybe disposed, or we have asset has been depreciated. But if you're given such a financial statement where you get told that the value of asset was X, was 2 million at the beginning, at the end is 1.6. We've not been told anything about disposal. So just means the asset has lost value. That is what we call depreciation altogether. So what is disposal when you say disposal? What is disposal? What is disposal when you say disposal?
It
What is
means
disposal?
when an asset is
Try. You can try. Try.
disposal.
Yes. Disposal, continue.
When an asset is no longer used.
When asset is?
No longer used.
When asset is done out.
It's no longer used.
When asset is done to what? Disposal should not be a big issue. But what is disposal? Basically, when you talk about disposal, when you've done away with asset altogether. For example, an asset has been sold altogether. So that is what we call disposal altogether. So when you've sold an asset, are we together? Or the asset is basically involved in an accident altogether. So that would be disposal of an asset altogether. That would be basically disposal of an asset altogether. So what happens when we dispose an asset? When we dispose an asset, what happens? So we're not talking about gain. I've not talked about gain. I've not talked about gain and others. Though very important point. I was just talking about disposal. So when you dispose an asset, you can either dispose it at a gain or at a loss altogether. Let's say, for example, at the time of disposal, the asset was 4. At the time of disposal, the asset was, let's say, maybe 2 million, and you've sold it at 2.2. So that is a disposal gain. But when you talk about when you sell it at a value less than the net value, at the time of disposal, that is a disposal loss. Tuko pamoja. Are we together? That's good if you're together. So let me just share with you something. So just say when an asset is sold, when an asset is sold, we say the profit. So the profit or loss made, the profit or loss made on the sale of the asset, is to be calculated. is to be calculated. So number one at the back of our mind, we know that disposal is when you sold an asset altogether. So when you sold an asset, we need to calculate the gain or loss that we experience from selling the asset altogether. The gain or loss that we experience from selling an asset altogether. So when it's a gain, it's disposal gain. We know that disposal gain is an income, disposal loss is an expense. So we can continue and say this. I say the profit or loss, the profit or loss, the profit or loss on the sale of an asset, on the sale of an asset, is then transferred to the profit and loss account. So after disposing an asset, we find whether we have disposed it at a gain or at a loss. So that loss or gain we transfer to the P&L, we check it out. So for the purpose, we say for the purpose of calculating profit and loss, for the purpose of calculating profit or loss on the sale of assets, profit loss for the sale of assets, disposal, we say disposal account, disposal of asset account, is opened. Then say the relevant entries, the relevant balances are transferred to this account. That the relevant balance are basically transferred to this account, that account together. So very important together. So the first entry, we can have number one entry. Entries. We know that those are entries. So the first entry we say cost price of an asset. So that is the value of that asset that that was bought. What do you do to that value? That value, we're going to do what? Remember, we open the disposal account together. We are going to debit disposal of asset account, debit disposal of asset account, disposal of asset account, and credit asset account. I want to explain this. So the first entry, we're talking about the cost price. Tuko hapa pamoja. Elizabeth, are we there? Elizabeth, tuko sawa?
Yes.
So at that point, the cost price of an asset, what we do with it, we debit it. Once we open the disposal account, we debit the disposal of asset account and we credit the asset account. Why do you credit asset account? Because we're doing away with that asset altogether. We are doing away with the asset. So we debit the disposal of asset account, the account that we created, and we credit asset account. Why are we crediting? Because we have sold that asset together. So entry two, we say that entry two, we're basically saying that we go to total, we talk about total depreciation, charged against asset, charged against the asset. Total depreciation charge against the asset. Total depreciation charge against the asset. At the time of disposal, for example, maybe the asset has lost value to a certain percentage. What do you do to the total depreciation charge against the asset? Total depreciation charge against the asset. So we do this. We say we debit depreciation, depreciation provision account. Why do you debit? Remember, if you're increasing depreciation provision account, if you're increasing with credit, why do we debit it together? Because that asset is no longer there together. So we debit depreciation provision account, and then we credit, the disposal of asset account. We credit the disposal of asset account. Why are we crediting it? We are looking at the trade of our asset is losing the value. We credit it with that total depreciation. Are we together? Then number 3 is now when we receive sales proceeds. We call it sales proceeds. Sales proceeds of an asset. Sales proceeds of an asset. Now when we receive the sales proceeds together. So at this point, look at this entry 2 and 1. If I was to cost minus accumulated depreciation, that will give us the net book value. Are we able to see that? At that point, we can have entry 1, we have the cost and accumulated depreciation. So we can easily get what? The net book value of that asset. We are going to use practical examples, don't worry. I bet you we are going to use practical example, don't worry. We are going to use practical example. So don't worry. Is that okay? Betty? We are going to use practical.
Thank you.
Yes. Then we have sales proceeds. Now, when we receive the sales proceeds, we know that cash is coming in, so we debit cash account, and then we credit what's called disposal of asset account. Disposal of asset account. We credit disposal of asset account. We credit disposal of asset account. We credit the disposal of asset account. I want us to have an NB. That is number 4, NB. I dictate that NB. Then I give an example. As I give you the example, you go for break, then you come back. So any balance, we say any balance. I dictate any balance. Are we there? Any balance remaining in the disposal of asset account, any balance remaining in the disposal of asset account will represent any balance remaining in the disposal of asset account will represent profit, will represent a profit or loss on the sale. A profit or loss on the sale will represent profit or loss on the sale. First of all, say this. The balance is transferred. The balance is transferred. The balance is transferred. The balance is transferred to the profit and loss account at the end of the year. It's transferred to the profit and loss. The balance is transferred to the profit and loss account at the end of the year. At the end of the year. It's transferred to the profit and loss at the end of the year. So we can give example as we go for break, then we come and tackle that example. Let me wrap this side, then we give that illustration. Not even example, but just illustration on what we are saying. Illustration. Illustration. So say this on the illustration. We can have that illustration. So illustration, you can say this. On 1st January 2020, on 1st January 2020, tuko sawa? Tuko sawa on 1st January 2020, a company purchased two motor van costing 30,000 each. 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 You say full stop. The policy of the company is to charge the position. The policy of the company is to charge the position at the rate of 20% per annum. The policy of the company is to charge the position at the rate of 20%, is to charge the position at the rate of 20% per annum on reducing balance. Is to charge the position at the rate of 20% per annum on reducing balance. First of all, say that a full year deposition is charged in the year of acquisition. A full year deposition is charged on the year of acquisition, but none in the year of disposal. 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 One motor vehicle, full stop, when you say one motor vehicle, one motor van or motor vehicle, one motor van was sold on 15th October 2022. Was sold on 15th October 2022 for shillings 15,000. Was sold on 15th October for shillings 15,000. I repeat again. Umeandika kitu Jeruto Masi ama nianze tena. Illustration is
Again.
I repeat the whole question ama umepotea wapi? Should I repeat the whole question? The whole illustration, sorry. We're simply doing illustration, just a small illustration, just to pick that concept. Should I repeat the whole thing? I'm waiting for you.
Nilipotea hapo introduction from the 1st January 2020.
On 1st January 2020, on 1st January 2020, a company purchased two motor vans, costing 30,000 each. Costing 30,000 each. Full stop. Tuko sawa hapo Masi?
Oh.
The policy of the company is to charge the position at the rate of 20%. The policy of the company is to charge the position at the rate of 20% per annum. At the rate of 20% per annum on reducing balance. At the rate of 20% per annum on reducing balance. At the rate of 20% per annum on reducing balance. First of all, say a full year deposition is charged in the year of acquisition. A full year depreciation is charged in the year of acquisition. In the year of acquisition. And none in the year of disposal. But none in the year of disposal. Masi mko sawa?
Oh.
First of all, say one motor van was sold on 15th October 2022. One motor van was sold on 15th October 2022. 2022 for shillings 15,000. 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 Then required. Write up motor van. Write up motor van, comma, motor van, comma, depreciation for motor van, depreciation for motor van, and disposal of motor van accounts, and disposal of motor van accounts in company's ledger, 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 in company's ledger. First, write up motor van, depreciation for motor van, depreciation for motor van, depreciation for motor van, and disposal of motor van account in company's ledger. That is the question. So we can have our break, but then come back for that question. So our team, are we together?
Sawa. Sawa.
Okay, we can have our break. Tuko hapo tafadhali. Are we there? If you're there, we just respond with yes. Are we there? We respond to that fire there.
Yeah.
Tuko pamoja.
Tuko pamoja.
Asante if you're there. So we've been told that just to read the question, then we analyze it. So we've been told on 1st January 2020, a company purchased 2 cars at a cost of 30,000 each. So the policy of the company is to provide depreciation at the rate of 20% per annum on reducing balance. A full year depreciation is charged in the year of acquisition and none in the year of disposal. Are we together? One motor van was sold on 15th October 2022 at shillings 15,000. So write up motor van, depreciation for motor vehicle, and disposal of asset account. Tuko pamoja. So 2 things that I want us to understand them. 2 things that I want us to. So we are told to open ledger accounts for 3 accounts. Motor van account. We have motor van account. We have provision for depreciation. Depreciation of an asset account or provision for depreciation. And then we have what? We have the disposal of asset account. So we can start with the first account, that is motor van account. Motor van account. Motor van account. Tuko pamoja. Munaona hiyo? Hiyo inaonekana?
Yeah.
Sawa sawa. And wrap this so that we don't for some calculations. So you say 2020. 2020. So that is 2020. So 2020, we can call it not balance breakdown, but you can call it cash. The total value of assets ni ngapi? 60,000. Si tumeelewana? You see what I have on 2020, January, 1st January. Sawa on asset account. Here iko sawa. You know where I've gotten 60,000 because each motor vehicle was 30. So at the end of the year, we know that DEC 2020, the balance carried down should be 60 as the value of our asset. Tuko sawa on that? Kila mtu anaelewa hiyo?
Mimi nina lag behind.
Nimesema ukiona hii 60 hizo motor van zilikuwa ni pesa ngapi each? 30. So 30 times 2.
30.
Yes, 30 times 2 is 60. So we are saying cash because automatically this asset was either bought through bank or cash all together. So at the end of the year,
Okay.
the value of the asset is still 60. So when we open 2021, we're saying that now balance breakdown, that is 60. As the 31st, then 2021, we have balance. We have balance carried down. Balance carried down as 60. So we still have 60. The reason why we're not lessing depreciation because we have an account for provision for depreciation. Sawa. So in the year 2022, which is the last year, we have 2022, we have balance breakdown, that is 60. But two things are happening here. On this year, 2022, August, there's disposal altogether. There's what we call disposal. Are we together? That is disposal. So we have disposal. One car was disposed. How much was that car that was disposed? The other one we remember at cost, that is 30,000. Tunaelewana? So we are able to see that. We're saying that on October 2022, one motor vehicle was disposed. So at the end, we have 31st, then year 2022, balance carried down for the value of the asset should be 30. Tumeelewana hapo hiyo account ya kwanza. Elizabeth, tuko sawa? Elizabeth, tuko sawa? Elizabeth, Betty, Ellen, and Mercy, tuko sawa?
Which date are you using for the
For the
balance for the
balance carried down,
balance carried down after the disposal? Is it 31st of
December 2022?
Okay.
That is at the end. When you say balance carried down, that is at the end of the year. Balance carried down at the end of the year. Because we sold one asset, so we have a balance carried down of what? Of 30. Tumeelewana?
Yes.
So then our open accumulated provision, accounted provision for depreciation, provision for depreciation account. So it means that we have to calculate depreciation values altogether. So we have to calculate, so we have year one, which is 2020. Are we together? And I want us to be very keen. And I want us to ask questions. Sometimes I feel the class is quiet for a long time. Now, why are we quiet? So year one, depreciation is at the rate of what? 20% on reducing balance. So year one, there's no accumulated depreciation, but you have 20% times how much is the cost? The cost we have as 60. We can get it there. So what is the depreciation for year one? Which is 2020. Munipatie hiyo figure tafadhali.
1,000.
How much?
12,000.
Wait. 20% of 60,000. How is it?
It's 12,000. 12,000.
Yes. So this is the depreciation for year one. So when I open provision, I'll say P&L, that is P&L, that should be 12,000. That's accumulated. Then you have balance, brought the balance carried down, that is that first deck, balance carried down, that should be 12,000. So this is 12,000. Remember, for depreciation is an expense. So we were debiting P&L and we credit what? We credit provision. So provisional, we credit with P&L. P&L. So that is the depreciation. You know that is the depreciation. So when that is 2020. Remember, this is 2020. So 2021, we have balance, the accumulated depreciation. Balance brought down is 12,000. So what is the depreciation year two? Year two. Let's look at year two. Remember, year two depreciation is what calculated on what? On reducing balance. So net book value. So the net book value we have 60, year two 60,000 minus depreciation for the first year, which is 12,000. Then you multiply by 0.2. So what is depreciation for year two, which is 2021?
Utamwaga hiyo chai. Utamwaga hiyo chai.
What is that? Elizabeth keeps on going out, coming in. Going out, I don't know the challenge.
Bread hakuna.
So what is that depreciation for year two?
9,600.
We cannot come to an accounting class without calculator. We cannot come to class without calculator. Make sure you have a calculator. So we say P&L, because that's depreciation, 9,600. So what is the total? Ukiongeza hizo, then you have balance carried down. What is the total? 9,600 plus 12. That should be 21,600. Then you have 21,600. Balance carried down should be 21,600. Then we have 2020, 22. So we have balance brought down. That is the beginning of the year. That should be 21,600. 21,600. So year three. Tunaelewana hapo? Year three. Tunaelewana year 3? Are we there on year 3?
Yes, yes.
So on year 3, and I expect Ellen na Betty pia waulize swali and they participate. Calculation classes need a lot of participation. So there's a statement that has been made there. If you're very keen, you can see that statement. We are being told that a full year depreciation is provided on year of acquisition and none on the year of disposal. So when you're disposing an asset we don't provide for its depreciation. Meaning on the third year, we're only providing for depreciation of only one asset remaining. Tumeelewana? A full year depreciation is provided on the year of acquisition and none on the year of disposal. So 2022, we only have 30 together because we don't provide depreciation for an asset that we are disposing. Tunaelewana Betty, tunaelewana Ellen, tunaelewana Mercy. Ellen, are we together?
Yeah, we are together.
Mercy, are we together? Okay. So we're only providing for this of 30 together. So what is accumulated depreciation? Accumulated depreciation for only this asset you're purchasing. Remember, these were 2. So this is 6,000, you less 6,000. And for year 2, you less 4,800. Tunaelewana, mnajua nimepata 6,000. A full year depreciation is provided in the year of acquisition and none on the year of disposal. So one asset we don't provide for is depreciation in 2022, which is year 3. Tuko sawa, which is year 3. Tuko pamoja. Watu wangu tuko pamoja. Tuko pamoja.
Yes.
Asante Ellen. So I'm simply providing for one asset. That one asset in the first year, it had depreciated 6,000. Remember, these are 2. Year 2, 4,800. Then for the third year, we multiply by 20%. So what is that depreciation on third year? So 30,000 minus 6,000 minus 4,800. Then you multiply by 20%. What do we have? Then what do you have for that? So the position for that one asset is 38.40. Tuko pamoja? Tumeelewa venye tumepata hiyo? Watu wangu, tumeelewana?
Yeah, tumeelewana.
Power.
Yes. I repeat again, depreciation is provided for in the year of acquisition and none on the year of disposal. So on top of the 3, because we dispose one asset, we take into consideration only one asset remaining. That's why I'm saying accumulated depreciation for that one asset was 6,000 in the first year, second 4. So the third year is that. So we have 2022, we say P&L 38.40. So when you add it, what do we have? 0.4525. So we have that as the total 25 or 40. So we have balance carried down. That should be 25 or 40. So if you look at this, we know that accumulated depreciation for this asset for the 3 years is totaling to that together. I open what? Disposal of asset account. I open disposal of asset account. Where can I have this? Do you have this? Do you have that? Tunaelewana? Can I have this? Ellen, can I have this?
Yes, yes.
Yeah, you can rub. You can rub on it.
Lazima munisaidie. Tunasaidia. We must work as a team. If you don't work as a team, nataka uangalie hizo double entry. So we call disposal, 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 of motor van account. So the first entry ilikuwa ni we debit motor van and we credit asset account, which already to the credit that is for disposal. So tutaweka kwa motor van at cost, that is 30. Tuko pamoja? At cost, that is 30. Tunaelewana? Tumeelewana? 30 tulikuwa nayo already kwa ile asset account. So when we credited, we should have debited that account together. We should have debited that account. So in the second step, you're told that to, what do we do?
Mwalimu, hebu rudia hapo.
Tunasema tukidispose at cost. Angalia hizo entry number 1. When we're disposing the cost price we debit with disposal of motor van account and we credit asset account with 30. Unakumbuka hapo chini nilisema disposal 30. The other entry is this 30 debiting motor van account, disposal of motor van account. Tumeelewana?
Yeah.
Betty, tuko pamoja? Naomba uitike. Kama uko nyuma bado I still explain.
Mi bado nina
Betty, unaona hii chini?
cost price.
Angalia ile account nimefuta. Umeona ile account nimefuta? Do you have it? Unaona pale chini
Yes.
disposal hapo chini. Disposal of 30,000.
Oh. Yes.
Yeah, there should have been an account again. We debit disposal account with motor van.
Oh.
Masi sasa unaona. Then the next account tunasema nini?
Credit. Yeah.
So the next, what do? We say we
Credit,
debit
yeah.
provision for the possession account, and we credit what?
Asset account.
And we credit what? We debit provision for deposition account. We debit provision for deposition account, and we credit disposal account together. So that's an entry that we should make here together. Angalia hapa. Tuko pamoja hapa. I want what do I take it tafadhali? If I put these values without you responding, we will never understand. So I'm saying at the time of disposal, angalia hapa. I want us to look up here. Mercy
Tuko hapo tu.
element. Mercy
Tuko hapo.
element. Yes, respond. That is the only thing that I need. I don't need anything but just response. So I'm saying at the time of disposal again, we say we debit provision for deposition account, and then we credit what? And then we credit what? We
disposal of
asset account. So tunakwenda kwa disposal account that we should make there. We say provision for depreciation. Provision for depreciation. So before we dispose this asset, how much value had it lost? It had lost 6,000 here, and it had lost 4,800 and there. So provision for depreciation ni ngapi? Ni 10,800 altogether. Tuko pamoja? Kama hujaelewa unasema kitu. Ellen, unanipata?
Bado.
Masi unanipata? Betty unanipata?
Repeat mwalimu.
Hapana, hiyo 10,800.
So before we dispose this asset in 2022, angalia hapa. It had, remember these are deposition for two assets. It had depreciated upper 6K, upper the second year 4,800, 4,800. So before the time of disposal, this asset, are we together, had lost a value of 10,800. Tunaelewana?
Yeah.
Yes, so that is what, and we should debit it here. Are we together? We should debit it in here together. Or tunaitumia for what call PPE schedule together. We can use it here or PPE schedule. So we debit that together. That is the second entry. The third entry, we are saying that when we are receiving the cash, remember we received the cash of 15,000. We are going to debit cash account. We create cash, another cash here, we're going to debit cash account because money has come in and we're going to credit what? We are going to credit disposal account. So we credit disposal account with a cash of 15,000. Tumeelewana?
Hapo sawa.
Are we together?
Yes.
If I was to open a cash here, I'll say cash account, kuna cash imeingia, tunasema disposal of motor van. Cash imeingia, this is cash account, that is 15,000. And then we credit disposal of that. What tunaelewana? Tunaelewana? What wangu? I cannot do anything without you, unless I will be doing my own things. And I expect questions. At this very level, I expect questions. You may not understand everything, but you understand 80%, 60%, 30%. But the minimum should be 70, 60 going onwards. Tumeelewa what I've done here. Hakuna mtu anaongea.
Hapo sawa. Hapo sawa.
Yes.
Hapo sawa.
Hapo sawa. So what is happening? There's a balance carried down here. Tukiangalia, what is the balancing figure? Sasa gani ni kubwa? It is 30 ndio kubwa, si ndio? So 30 ndio kubwa. So what is happening altogether? The difference, what is that difference altogether? What is that difference? We have a difference of what? What is this difference that is there?
4,200.
4,000?
200.
4,000. Is it a gain or a loss? If it's on the credit side, that is a disposal. We call it disposal loss. Are we together? Of 4,200. So hii tunabeba the difference tunapeleka P&L. So when you take this to a P&L, this would be an expense. This would be an expense together. But I want to explain in a layman language. Hiyo asset ilikuwa ni ngapi 30. By the time we are selling it, tulikuwa tumelose ngapi? Tumelose 10,800. Meaning, at that point, the net book value of this asset ilikuwa ni 19,200. Before we sold this asset, what was the net book value of this? The net book value was 19,200.
Sure.
Na sisi tukauza 15,000. Tumeuza chini ya net book value. Meaning the difference, which is 4,200, is a disposal loss. When you have the entry on this other side, the debit side, that would be a disposal gain. Disposal gain. That will be a disposal gain. Tuko sawa watu wangu? Ellen.
Yeah, we are together, mwalimu.
Asante. And please, the heart of responding. Mercy, the heart of responding. When you're doing a calculation, number one, kuwa na calculator, angalia hizo double entry. You know, like now I'm simply picking these things from the entry. I'm simply just picking those entries that I gave you. So we must learn to be very keen and we respond. Otherwise, God bless all of us and we meet on Friday. Mungu awabariki. Asanteni sana, you can leave.
Okay, thank you.
Asante mwalimu.
Asante.
Thank you.
Thank you so
Thank
much.
you. Okay.